You're watching the Fox 5 Morning News at 7.
The Federal Reserve recently cut interest rates for the very first time this year. Chase Wilsey is back to talk about what this could mean for our financial future. Chase, good morning. Always good to see you.
Good morning. Good to see you too.
We hear about these cuts, these increases, cuts, increases. What does this actually mean to the average person?
You know, I think it obviously gets a lot of media attention. And what essentially happens when the Federal Reserve cuts interest rates, people have this misconception that they're, maybe cutting mortgage rates or they're cutting savings rates. They're not directly doing that. What they're doing is they're cutting something known as the Fed funds rate. And ultimately, this is what is charged to banks as an overnight lending rate. But the reason it's that important is because it does set the baseline for a bunch of other borrowing rates, for savings rates. So it is an important thing to follow, but you have to understand the different impacts that it has on various rates and the economy as a whole.
Inflation has always been a concern for everybody. So could this recent cut help?
Well, the interesting thing is generally you increase rates to reduce inflation. So this is a very interesting time period where the Federal Reserve has a dual mandate for employment and inflation. Those are their two things that they really focus on. We have seen a weakening labor market, but inflation has remained stubbornly high. So right now they're not cutting interest rates necessarily to help inflation. That could actually hurt inflation. If they cut interest rates by, let's say, 2 percentage points, you're going to stoke demand, you're going to have potentially higher inflation. But the reason they're cutting interest rates is to help potentially with the labor market, since we have seen a nice softening in that development.
Labor markets, one category. Now the market that we check in with every day here, how will it affect that?
Generally, cutting interest rates is a positive for the stock market. There's some theories, obviously, that if you have a cut in interest rates, well, now that makes savings rates. You're going to get less interest on your, savings accounts, your money markets. That might lead to money flowing into the stock market. So generally it should be a benefit to stock prices. My only concern is we have seen such high valuations on the stock market that generally you don't really have a cutting cycle when valuations are at 23 times future earnings like we're seeing in the S&P 500. So it'll be interesting to see how it plays out, but generally it's positive for stocks.
Everybody wants the economy, obviously, to grow. So these lower interest rates, is it a negative impact on economic growth, positive impact?
Well, generally it's going to be a positive impact on economic growth because, again, it should have less money now in savings, and that money should then be redeployed.
You said
into
should.
economy.
You said should a few times.
Should. It's such a variable impact that you don't really know how it's going to play out until it's over. But the big thing that I can tell you is with a 1 percentage point cut in these rates, JP Morgan Chase's chief economist David Kelly, who I really respect, I think he's got a great pulse on the economy, he said for every 1% cut, it actually cuts money market income by about $140 billion across the whole economy. So what happens is he believes that for every 1% cut, you actually lose more in income, interest income, than you benefit from interest expense. So it can be a negative if you have more in savings and you're not as necessarily reliant on loans. It hurts you more than it helps you.
What about home ownership?
Home ownership, this is an interesting category because what happens is the short-term interest rates generally don't have a long-term impact on those long-term rates. The 30-year treasury, the 30-year fixed mortgage is generally going to follow the 10-year treasury, and that's more dependent on supply and demand. So every time they cut interest rates, it doesn't necessarily mean you're going to see lower mortgage rates. In fact, last year, the 30-year mortgage was around 6.2% in September. Well, then the Fed cut rates 3 times. The 30-year mortgage actually went up to over 7%. So don't think that just because they're cutting rates that the 30-year mortgage is going to fall.
Yeah, see, you just don't know. You don't know, and that's why we have people like Chase here to explain it. Always good to see you. Thanks for being here.
Thanks for having me.
All right, Chrissy, let's get it over to you.
Fox 5 Weathers.